Let's take a look at benefit policy issues. Benefits are an important part of just about everyone's compensation. Employers, therefore, should design benefits packages carefully, and there are many policy decisions to make. These include what benefits to offer, who receives coverage and when, how to finance benefits, and how to communicate benefits options to employees. Federal and state laws mandate some benefits, such as Social Security, while other benefits are voluntary at the employer's discretion. However, federal law still affects even voluntary or discretionary benefits such as vacation leave, and employers must adhere to the laws of states in which they do business. There are many benefits and ways to classify them. All states have their own unemployment insurance or compensation law. These provide benefits to eligible workers who become unemployed through no fault of their own. The benefits derive from a tax on employers that can range from 0.1 to 5% of taxable payroll in most states. An employer's unemployment tax rate reflects its rate of employee terminations. Unemployment tax rates are rising in many states. For example, prior to the 2007-2008 recession, Maryland's unemployment insurance tax rate was 0.3% or lower, but now ranges from 0.6% to 9% per employee. Not everyone dismissed by an employer is entitled to unemployment benefits, only those released through no fault of their own. Strictly speaking, a worker fired for chronic lateness can't legitimately claim benefits. But many managers are lackadaisical in protecting their employers. Employers therefore spend thousands of dollars on unemployment taxes unnecessarily. Managers should keep documentation to show that poor performance caused the dismissal. Most organizations offer vacation and holiday benefits. About 90% of full-time workers and 40% of part-timers get paid holidays, an average of 8 paid holidays off. Common U.S. paid holidays include New Year's Day, Memorial Day, Independence Day, Labor Day, Thanksgiving Day, and Christmas Day. On average, American workers get about 9 days off of vacation leave after 1 year's employment, 14 days after 5 years, and 17 after 10 years. Organizations should address several holiday and vacation-related policy issues, such as how many vacation days employees get and which days, if any, are paid holidays. In practice, vacation policies range from highly flexible to traditional, to restrictive, and some employers have unlimited vacation policies. Of course, unlimited vacation plans aren't really unlimited. Well, theoretically, there's no limit on how many days off employees can take. In practice, they must plan their schedules with their supervisors. As a rule, very few employees actually take more time off. Some employers concerned with excessive absence emphasize restrictive oversight. Sick leave provides pay to employees when they're out of work due to illness. Most policies grant full pay for a specified number of sick days, perhaps 12 per year, usually accumulating at the rate of 1 day per month of service. 6 states and several cities now have mandatory paid sick leave law. The problem with sick days is that many employees use them whether they're sick or not. In one survey, personal illnesses accounted for about 45% of unscheduled sick leave absences. Employers use several tactics to reduce excessive sick leave absence. About 87% use pooled paid leave plans. These lump together sick leave, vacation, and personal days into a single leave pool. In one SHRM survey, the average days awarded depended on employees' time with the employer and ranged from 13 to 26. Most firms don't include federal holidays in their paid time off banks. Another tactic is to repurchase unused sick leave at the end of the year by paying their employees for each unused sick day. The problem is that legitimately sick employees may come to work. Parental leave is an important benefit. About half of workers are women, and 80% of them will become pregnant during their work lives. Furthermore, many workers are single parents. Many employers enrich their parental leave plans to make them more attractive for mothers to return from maternity leave. Recently, there's been a discussion of the need for federal parental paid leave legislation. Many employers provide severance pay, a one-time payment when terminating an employee. Most managers expect to give them 1 or 2 weeks notice if they plan to quit, so severance pay seems appropriate when dismissing an employee. Reducing litigation from disgruntled former employees is another reason. Severance pay also helps reassure employees that they'll receive some financial help if let go as well. If the employer obligates itself to pay a severance, then its voluntary plan must comply with additional ERISA rules. The reason for dismissal usually affects severance pay. About 95% of employees dismissed due to downsizing get severance pay, but only about a third of employees offer severance when dismissing for poor performance. The maximum weeks of severance pay tends to vary by position. In one survey, about 45% of officers and senior executives got 52 or more weeks. 42% of professionals got 14 to 26 weeks, and 39% of administrative staff got 14 to 26 weeks. In any event, keep several things in mind when designing severance plans. List the situations for which the firm will pay severance, such as layoffs resulting from reorganizations. Require signing a voluntary waiver and general release prior to remittance of any severance pay, absolving the employer from employment-related liability. Reserve the right to terminate or alter the severance policy. Make it clear that any continuing severance payments continue only until the stated deadline or until the employee gets a new job, whichever occurs first. As with all personnel actions, employers must make severance payments equitable. Supplemental unemployment benefits are cash payments that supplement the employee's unemployment compensation. These benefits help the person maintain their standard of living while out of work. Workers' compensation law provides income and medical benefits to work-related accident victims. Every state has its own workers' compensation law and commission, and some run their own insurance program. However, most require employers to carry workers' compensation insurance with private, state-approved insurance companies. Neither the state nor the federal government contributes any funds for workers' compensation. Workers' compensation can be monetary or medical. In the event of a worker's death or disablement, the person's dependents receive a cash benefit based on prior earning. Most states have a time limit, such as 500 weeks, for which benefits can be paid. If the injury causes a specific loss, such as an arm, the employee may receive additional benefits based on a statutory list of losses. In addition to these cash benefits, employers must furnish medical, surgical, and hospital services as required for the employee. For workers' compensation to cover an injury or work-related illness, one must not only prove that it arose while the worker was on the job, it also is a matter of whether he or she may have been at fault. It's important to control workers' compensation claims and therefore costs. The employer's insurance company usually pays the claim, but the employer's premiums may rise with more claims. There are ways to reduce workers' compensation claims. First, new employees are most at risk, so early training is important. Also, reduce accident-causing conditions such as slippery floors or sloppy work habits. Furthermore, some workers' compensation claims are not legitimate. Red flags include vague accident details, minor accidents resulting in major injuries, a lack of witnesses, or injuries occurring late on Friday. Moving aggressively to support the injured employee and get him or her back to work is important too. Many firms have programs such as physical therapy assistance to do just that. Health insurance looms large in many people's choice of employer because it's so expensive. Hospitalization, health, and disability insurance help protect employees against hospitalization costs and from income loss arising from off-the-job accidents or illness. Experts forecasted the total cost of medical and pharmacy benefits to rise by 5% in 2018 to about $14,000 per employee. Most employer health plans provide at least basic hospitalization and surgical and medical insurance for all eligible employees at group rates. Most employers' health plans also cover health-related expenses like doctor's visits, eye care, and dental service. Other plans pay for general and diagnostic visits to the doctor's office, vision care, hearing aids, and prescription drugs. Disability insurance provides income protection for salary loss due to illness or accident and may continue until age 65 or beyond. Disability benefits usually range from 50 to 75% of the employee's base pay if they become disabled. Under the Patient Protection and Affordable Care Act, employers with at least 50 full-time equivalent employees are to offer minimum levels of affordable health care coverage or pay a penalty. The Affordable Care Act certainly didn't please everyone. For example, some say it entangles the federal government excessively in citizens' personal health matters. COBRA, the Consolidated Omnibus Budget Reconciliation Act, requires most private employers to continue to make health benefits available to employees and their families for a time, generally 18 months after separation. The former employee must pay for that coverage. Healthcare cost control is one big way an HR department can improve organizational profit. Cost control should start by measuring and auditing healthcare costs. One survey found that while the standard for claims errors was 3%, the actual percentage of claims with errors was about 6.3%. Consultants who audit employers' healthcare payments estimate up to 8% overpayment. Beyond that, for many employers, deductibles and copays are the low-hanging fruit in healthcare cost control. For example, at least 20% of employees were enrolled in high-deductible healthcare plans in one survey. Employers take other cost control steps. For example, employees use tax-sheltered health savings accounts known as HSAs to pay for low-dollar, not catastrophic, medical expenses. Some employers offer defined contribution health insurance plans. Like 401ks, defined contribution health insurance plans tie each employee's health care benefits to what they and the employer contribute. For employers, it can be advantageous to offer incentives to motivate sustained healthcare behavior change and promote a culture of health in the workplace. Incentives can boost wellness program participation, but the research is mixed. Long-term care insurance is a key employee benefit. The Health Insurance Portability and Accountability Act of 1996 lets employers and employees deduct long-term care insurance premiums from their income tax, making this benefit more attractive. Employers can also provide insurance benefits for related matters. Most employers provide group life insurance plans. Such plans generally offer lower rates than individual plans and usually accept all employees regardless of health or physical condition. In general, there are three policies to be concerned about here. First, the amount of annual life insurance is usually tied to employees' annual earning. Supplemental benefits are continued life insurance coverage after retirement as an example. Financing is the amount and percent the employee contributes. Accidental death and dismemberment coverage provides a lump sum benefit in addition to life insurance benefits when death is accidental. It also provides benefits in case of accidental loss of limbs or sight. About 19 million people work part-time, which is less than 35 hours a week. More gig work and more phased retirements and a desire to better balance work and family life help explain this phenomenon. Many firms provide holiday, sick leave, and vacation benefits to these part-time employees. Social Security provides three types of benefits. Retirement benefits provide an income if you retire at age 62 or thereafter and are insured under the Social Security Act. Second are survivor or death benefits. These provide monthly payments to you and your dependents regardless of your age at death, assuming you're insured under Social Security. Finally, disability payments provide monthly payments to employees who become disabled totally and to their dependents if they meet certain requirements. The Social Security system also administers the Medicare program, which provides health services to people age 65 or older. A tax on employees' wages funds Social Security. Recently, the maximum amount of earnings subject to Social Security tax was $128,400. The employer pays 7.65% and the employee 7.65%. Full retirement age for Social Security benefits is traditionally 65 years of age. Pension plans provide income to individuals in their retirement. Pension planners classify pension plans as contributory versus non-contributory plans and as defined contribution versus defined benefit plans. The employee contributes to the contributory pension plan, while the employer makes all contributions to non-contributory plans. With defined benefit pension plans, the employee's pension is specified in that the person knows in advance of his or her pension benefit. A formula usually ties the pension to a percentage of the person's pre-retirement pay. Defined contribution pension plans specify what contribution the employee and employer will make to the employee's retirement or savings fund. Here, the contribution is defined, not the pension. With a defined benefit plan, the employee can compute what their retirement benefits will be upon retirement. With a defined contribution plan, the actual pension will depend on the amounts contributed and the success of the fund. Defined contribution plans are popular among employees due to their relative ease of administration, favorable tax treatment, and other factors. The most popular defined contribution plan are based on Section 401k of the Internal Revenue Code. The employee authorizes the employer to deduct a sum from their paycheck before taxes and to invest it in their 401k account. The deduction is pre-tax, so the employee pays no tax on those dollars until after they retire or remove the money. Employers often match employees' 401k contributions dollar for dollar to a set percentage. With defined benefits plans, you get your maximum pension. You'll generally must stay with your employer until you retire. With defined contributions plans, your pension is more portable. You can leave with it at any time. The Employee Retirement Income Security Act of 1975, or ERISA, requires that employers have written permission plan documents and adhere to certain guidelines, such as regarding eligibility. ERISA established the Pension Benefits Guaranty Corporation, PBGC, to oversee and ensure pension if it terminates without sufficient funds. And that's been a major problem with defined benefit plans that are woefully underfunded. To trim their workforces or for other reasons, some employers encourage employees to retire early. Many programs take the form of early retirement window arrangements for specific employees. The window means that for a limited time, the employee can retire early, generally with a combination of improved or liberalized pension benefits plus a cash payment. Early retirement programs can backfire. In the early 2000s, Verizon offered an enhanced pension to encourage 12,000 employees to retire. When over 21,000 took the plan, the company had to replace 16,000 managers. Furthermore, unless structured properly, older employees can challenge early retirement programs for forcing them to retire involuntarily. To maintain legal compliance, the employee decision must be voluntary. The employee must have ample time to consider the agreement and seek legal advice. All are voluntary benefits, rather required or mandatory under the law. Employee assistance programs, or EAPs, provide counseling and advisory services such as personal legal service, adoption assistance, or mental health counseling for personal problems that may adversely affect the employee's work life. Few but the largest employers establish their own EAPs. Most contract with vendors. In either case, everyone involved, including supervisors and EAP staff, must respect confidentiality. Also, they keep files locked, limit access, and minimize identifying information. You always must be aware of legal issues. You must ensure that EAP vendors fulfill professional and state licensing requirements. Creating a family-friendly workplace through family-friendly benefits is important. Such benefits include childcare, elder care, flexible work schedules, paid family leave, and concierge services for help with tasks like grocery shopping. A recent study by the Brookings Institution listed some consequences of inadequate childcare, including harmful effects on children, lost productivity for employers due to parents missing work, and lost wages for parents. Employers who want to reduce the distractions associated with finding reliable childcare can help by recommending available options. Some are even able to set up company sponsored and subsidized daycare facilities. For many millennials, benefits like childcare reportedly often trump higher pay. Netflix recently told employees they can take a year off for childcare. Sick child benefits are important. Sending a sick child with flu like symptoms to school because the parent's work risks worsening the child's condition and exposing classmates and a teacher to illness. Yet only about half of US workers are eligible for paid sick days that they can use for family members, so they risk pay loss and job loss by staying at home. By one estimate, 80% of elderly care is done by family members. Helpful benefits for them include 10 to 15 days of backup elder care, scheduling flexibility, and leaves of absence. Employers use educational subsidies, usually tuition assistance, to help employees pursue educational coursework. By one estimate, almost 90% of US employers provide such subsidies. About 5.6% of undergraduate students received such employer support a few years ago, and about 14.5% of graduate students did. However, the benefit seems to be somewhat less popular than it used to be. Employers provide other personal service benefits to employees. By way of example, Google is well known for these personal service benefits. Google arranges with local vendors to provide on Google site programs such as ATMs, mobile libraries, bike repair, car washes and oil change, dry cleaning, haircuts and salons, and an organic grocery delivery service. Google does this because their on-site availability boasts employees' efficiency by reducing the need for them to seek services off-site. CVS Caremark, seeking to retain older employees, offers various elder-friendly benefits. Its Snowbird program lets pharmacists winter in Florida and work in the Northeast when it's warmer. Most Fortune 500 companies offer donation matching programs and other personal service type benefits. In most firms, domestic partners are eligible to receive health benefits. When employers provide domestic partner benefits, the employees, same-sex or opposite-sex domestic partners, are eligible to receive the same benefits as do the spouse or legal dependent of one of the firm's employees. In 2013, the U.S. Supreme Court struck down part of the Defense of Marriage Act. Under its ruling, gay couples married in states where it's legal must receive the same federal health, tax, and other benefits heterosexual couples receive. Then, in 2015, the U.S. Supreme Court held that same-sex couples can marry nationwide. After this decision, the percentage of employers providing same-sex domestic partner benefits dropped from 59 to 48%. Some employers, such as IBM and Verizon, said they would phase out domestic partner benefits, but gave employees who were receiving such benefits time to consider getting married. The trend is to not differentiate between various types of spouses in offering benefits. When you reach the pinnacle of the organizational pyramid, or close to the top, you'll find, waiting for you, the executive perk. Prerequisites, perks for short, are special benefits for top executives. Perks include management loans, typically to exercise executive stock options, financial counseling and relocation benefits, often including subsidized mortgages, purchase of the executive's current house, and payment for the move. Publicly traded companies must itemize all executive perks if they total more than $100,000. Many employers are reducing or phasing these perks out. One way to provide choice is with an aptly named cafeteria benefit plan. To paraphrase the U.S. Internal Revenue Service, a cafeteria plan provides participants an opportunity to receive a choice of certain benefits on a pre-tax basis. Qualified benefits include, for instance, accident and health benefits, adoption assistance, dependent care assistance, and group term life insurance coverage. Cafeteria plans come in several varieties. Flexible spending accounts are a form of a cafeteria plan that reimburses employees for expenses they incur in buying certain qualified benefits with pre-tax dollars. With a Core Plus option plan, the employer specifies a core set of benefits, such as medical insurance, which are required. Beyond those, the employee can choose, up to a limit, which other benefits they'd like to receive. Flexible work schedules are popular today. In one survey, about 70% of surveyed employees called flexible work hours very important. Flex time is a plan where employees' workdays are built around a core of midday hours. Thus, workers might opt to work from 8 o'clock in the morning to 4 p.m. or 11 a.m. to 7 p.m. Some suggest that inflexible schedules help explain both the gender pay gap and the fact that women hold few top management jobs. Telecommuting, or using technology to work away from the office, is popular. Almost two-thirds, 62% of employers, offer at least some telecommuting. Employers that offer telecommuting must calculate the program's benefits and costs. Telecommuting's effects on the environment, of course, are positive given reduced commuting. Many employees, like airline pilots, don't work conventional 5 40-hour work weeks. Workers like these typically have compressed work week schedules. They work fewer days each week, but on the day they work, it's longer hours. Some firms have 4 10-hour work weeks as an example. Job sharing allows two or more people to share a single full-time job. Work sharing refers to a temporary reduction in work hours by a group of employees.